Hello, my name's David Linton, and thank you for taking a trial of the Linton price targets on TradingView. And for the next 10 days, each day, I'm going to give you some tips that will help you make the most of the targets and your trial. So hopefully you'll find this valuable. And you can watch these back to back if you wish. We will send you a lesson each day so that you can actually just absorb how to make the most of the trials and to think about the targets as you use them. So this is the sessions that we're going to go through today. We're going to focus on where the targets actually come from, how they work, what generates them, and then we're going to go through these points every day. So sit back and listen and learn. So on day one, remember where the targets come from. It's an old technical analysis technique reimagined. It's that simple. It comes from point and figure charts, and point and figure charts came about back in the 1880s, 1890s, back in the days of Charles Dow, when really price movement on Wall Street could not be recorded. We didn't have computers to record all this information. Price was coming out on the ticker tape. 10 or 11 years later, it was on telephones. In fact, I remember myself having to ring my broker for a price before the internet and computers, really. But the key thing is that this was a way of recording price information. It was a necessary shorthand. And these charts were how people recorded chart movement. And it basically was a method known as the point and figure method. And it's largely died since the advent of the computer. And this book by A.W. Cohen, I've got this book, is really where he first of all talked about this method of an initial buying thrust leads to an overall potential of move. And so on point and figure charts, there is no time element. And basically this is how a point and figure chart looks, but not many people use them anymore. They're hard to understand, and one of the key things about the chart is there's no time element in the chart, so there is no way of knowing when a target might be reached. So over the course of many years, I've developed this way of taking the point and figure charts targets and putting them on a time-based chart. That's simple. There's no real rocket science to it. It's just an easier way to understand an old technique on a new chart. And I've had so many people say to me, why did no one ever think of this? And it certainly took me years and years and years of trying to make this work. But so this is where the targets come from. This is the same chart. This is a chart with the point and figure targets. And here they are on the time-based chart. And I always pose the question, which chart would you rather look at? Most people find this harder to use. Most people now are using time-based charts, especially candlestick charts. So the price targets were first announced in 2023. Been working on them for several years, and I launched them at the International Federation of Technical Analysts Conference in 2023. They were launched on Bloomberg earlier this year, so they're used by lots of professional technical analysts on Bloomberg. And inevitably, lots of people said, well, I don't have Bloomberg. So that's really the professional market has been what's been using these targets to now. They were peer reviewed in the 2025 IFTA journal. If you go to the International Federation of Technical Analysts website, ifta.com, you can see this paper. You can download it and you can read for yourself the paper which was peer reviewed into the journal. And of course you have them now. You have them either on the web or the app in TradingView or on your phone. So this is a really big step forward. So hopefully you're going to enjoy using these. So targets are about thrust. That's the key point. And the bigger this initial move, these are the three ingredients that you need for a price target. Basically, it's an uninterrupted initial buying thrust off a low, and then a pullback, and then a move to a new high that's significantly higher than the previous high, and that's what generates the target. This is what we call activation. So you need an uninterrupted buy, you need a pullback, and you need a minimum move above that buying thrust to activate the target. Now, I always use a cricket ball, remembering that if you're on the outfield of a cricket pitch, you will have to pull that ball a long way back to throw it to the wicket keeper. In baseball, it would be the keeper. You have to, if you're far away, you've got to pull your arm right the way back to give it an initial thrust. So the bigger that initial thrust, the bigger the move of the target. And that's where the targets come from. It's that simple. And so the key point about that is the target structure. And you need to understand that initial buying thrust is what leads to the overall potential of the move. So these thrusts here have produced these targets. Those initial buying thrusts and the activation levels have produced those targets, and that's where they come from. And the great power of this is that you can use them with other techniques because it's a time-based chart, so you can use them with Bollinger Bands. And in fact, John Bollinger's seen these targets and is impressed by them. And as he says here, ways to bring the technical analysis without abandoning that value in the past. So that's where the targets come from. And the simple thing is just to have a look at them on TradingView. This initial, there's a thrust there that produced a target to here. We're almost at that target. This is on the S&P. And then there's another target here producing another target. And this is where they come from. So it's really simple that buying thrust is what produces the target. It's not rocket science. It's just that initial buying, and in the case of a downside target, or selling, that produces the buying wave. So we can go through a series of charts. It puts the targets on for you. We will talk in the coming lessons about the default settings. I recommend you start out today just using the default settings, just getting used to the targets. See, we have a buying thrust that produces an upside target that was met. We have a selling thrust that produces a downside target that was met. An upside target here produced, and these are the levels. And we can go through and you can look at any chart you want for these thrust moves. So really quite key. And not every chart will have a target on, but most will. And so that's the key thing, is that you can apply these targets on any time frame you like. So this is the first lesson. Just get used to going through different stocks, different charts that you're looking at, and really just use the default settings to begin with. And we will, as the course of your trial goes on, we will look at the different aspects of using the targets. The key thing is that buying thrust is what produces the move up, and this selling thrust is what produces the move down. It's that simple. Now, we're going to get into lesson 2 tomorrow, but hopefully you'll get started with playing with the targets, and you can work out some of the power of using them. Until tomorrow, bye for now. Hello, and welcome to day 2 of your trial. What's your time horizon? This is a very important factor when using price targets. And today I want to focus on time horizon and chart frame and unit size, and in terms of using the target. So this is a very important factor of using the targets, and really important. This is a table that I developed in 2010 in a book I wrote on Ichimoku charts. And this idea that a daily chart, we're thinking weeks ahead, and we look back months to produce that view. So days means weeks, weeks means months, hours means days. The time frame chart that you're looking at defines the view. And this is a really powerful aspect of technical analysis, in that you can actually make calls or predictions about what's going to happen in the coming hours, the coming days, the coming weeks, the coming months. That's very hard for a fundamental analyst to do. And so by changing the time frame of your chart, you change your time horizon. And so some people will consider, if you're a short-term trader, you'll consider that these time frames, you might consider a daily chart as long-term. And if you're a very long-term trader, then you would consider a daily chart potentially as short-term. So different people have different views of what long and short-term is. But as a general rule, I like to say that the medium-term chart is the daily chart. And one of the things we find is lots of people are looking at the wrong time frame chart for the time horizon that they're trading to. So this is a really important thing to get right. And when it comes to the time of the chart, this is also important for the price targets. Now, the price targets project into the future, and you can see here that we are projecting, for example, that this target might be met at this time and this target might be met at that time, but this is on a daily chart. So this is medium term where we're thinking weeks ahead. And then if we go to a 60-minute chart, now we're thinking about the days ahead. So the targets are now pointing to days ahead. And then if we go to a long-term chart, a weekly chart, and a lot of point and figure people would not think of using a weekly chart when you've got the daily chart as your filter, but we can put the targets on weekly charts for long-term targets. And here, for example, we can see target into 2029, 4 years away, because it's a long-term chart. So getting that time frame right is really quite key. Now, the next thing is, in point and figure terms, we talk about box size. Now, the idea behind a box size was what filter do you want to apply? Now, in the targets talk, we talk about this as price units. And you can imagine that in terms of the setup, and we talked about this yesterday, in terms of the setup, you have this pullback, needs to be of at least 3 units, and then the activation needs to be at least a unit. So these units define whether you're going to get a target or not, and how big the targets will be and how sensitive it is. So how much of a pullback do you need? If you're using $1, you need $3, and you need an extra $1 to break out. If you're using $10, you need $30 and $10 to break out. So the unit size is what defines the sensitivity of the chart. And so this is a really important aspect of using the charts. So here we look at a unit size based on price. And for example, on euro-dollar, which has a value of around 110, here we're 116. Here we're seeing 1 cent as the unit size, around 1% of the price. If we look at the NASDAQ, using 1% of the price, we get 250 points. There's no point using a 1 cent chart or 0.01 on the NASDAQ, and there's no point in using 250 points on the euro-dollar. So as a rule of thumb, we start with a unit size, a sensible size near 1% of the price. Now, I'll talk to you about the defaults in your targets in a minute, but this is the understanding that different charts will need different unit sizes because of the denomination of the chart. Now, that's the first step. The second thing is, how sensitive do you want to go? So here is a target on the NASDAQ, 250 points, and here is a target on the NASDAQ using 100 points. For this one, you need a pullback of 750 points. And for this one, you need a pullback of only 300 points. So it stands to reason that you will get more targets on the more sensitive chart with a smaller unit size, because there will be more pullbacks and more interrupted buying thrusts and more activations. So the smaller the unit size, the more targets that you're going to get. So in thinking about unit size and time horizon, I put this extra row in here, which is on daily charts, I tend to use around 0.5%. And on long-term weekly charts, I use 1%. And on 60-minute charts, I use 0.1% or down to 0.05%. So the chart frame is effectively a filter, but also the unit size changing the chart frame is quite key. So the key thing here is to look at the unit size as we go through the charts. Now, in terms of your settings in the targets, we've automatically calculating the unit size on the default is 0.5%. We're using log scale. We'll talk about the difference between arithmetic and log in one of the future lessons in the coming days. And we're using the close price and reversal. Those are the settings that we use. So what's interesting here is on daily charts, we're using 0.5%. And if we go down the settings, on intraday, there's also default sizes. So this is all effectively handled for you. So what I recommend you do to start with is that you just stick with the log scale unit sizes that are in the default. So you can see here that we go through the charts, and because of those defaults, every chart is applying that 0.5% on a daily chart. And if I wanted to go to 60-minute charts, and I can do the same on the Dow, so you can see here the price units on the Dow: $156, $300, $290, $417, $69. So all of those different price points effectively produce different unit sizes. There's a target that's been given and met. And if we look at Coca-Cola, for example, we see here a downside target that's been generated here, activated to the downside. Now, if I went to a 60-minute chart, that is going to change to use the default now, and the unit size is quoted there at 0.05%, and so we're using a more sensitive unit size. And so on your intraday charts, you'll find that's 0.5%, and then when you go back to a daily, you'll find that it's gone up to 0.5%, so 0.05 and 5. So those are the defaults, and I recommend you stick with those just while you're feeling your way around using the targets. But hopefully you can see the value of time horizon being a really important factor in the chart. So stay tuned for tomorrow's lesson, and hopefully you find that valuable. Welcome to lesson 3, target notation and thinking about activation and negation. Understanding the status of the price targets is a really important factor in using them. And so today, I want to focus on just understanding what you're seeing when you see the targets on your screen. So we use a traffic light system. That's how we've set that up as the default. You could change the colors if you want, and there are various things in the settings that you can change. But the way your system has been set up is that green targets are the upside, red targets are to the downside, and orange targets are targets that are not yet activated. So it's just a classic traffic light system. This target will turn to red if it is activated. So it goes from orange to red. So that's a key thing. Green targets, upside targets, red targets, downside targets, and orange targets can be either direction, unactivated. And so the key thing is also that if a target is reached, then it's not bold, but if a target isn't yet reached, it's effectively still in bold. So that's a key factor. And we say here that the more recent targets are going to be the ones that are important, of course. That's a very important factor as well. So the target notation is green is up, red is down, and we think about that in terms of and all of these are configurable in the settings. But I recommend you stick with the default settings for the moment. And we also add here in this dialog where you can see the number of activated and unactivated targets. So the status of upside price targets is, in terms of understanding them, is if a target is reached or achieved, if a target is exhausting, so we're not quite getting to that target, or the target is activated. And in this area, we call the target as in train. If we fall back below the activation level, back into this area, we're back below the point at which the target was generated, then we can start to say the target is deactivated. It's not really, it's not failing, but it's just we're back in the zone where we haven't held that level. Holding that level is quite important. And then if we fall through the reversal point, that's effectively a lower low, and that then tends to tell us that the target is failing. And if we fall below the level from which the target was generated, the base of the target, then all of those buyers have gone. We've now got new sentiment, new information, whatever. But now all of those buyers are negated. That target is negated. So The key things are a negated target, an activated target, and an achieved target. They're these sort of semi-states that exist in between. And on the downside, it's the same idea. This selling thrust here produces this downside target here. Here the target is negated, the target is failing, and then at this point here, if we're achieved, the target is achieved, and exhausting when we don't quite get there. So it's worth understanding just whether a target is negated, activated, or achieved in terms of understanding that. Now, the target status in TradingView, you can actually go and see these in the settings, but these are the targets are in train. This is target not yet activated. If we move above the activation level, which is 1 unit higher than the top of where the target was generated, this will turn green. And normally you should wait for a target to be activated. If you like, it's get ready to go, like sitting at the traffic lights, but you normally wait for a target to be activated. So that's quite key. So here we see that target is yet to be activated, and here we have an active downside target, but it's now less valid as we're moving back into the area where the target was actually generated. Targets are negated before activation. So a target that's negated before activation, well, the target was never activated in the first place. That's quite key. And you can have these on your system in grey. We don't include them in the defaults, but you can set them up in the settings. I would say don't get too obsessed at this stage with negated targets. A target will disappear off the chart if it's negated. If you change the settings so that you want to see it, you can set it up as grey, and then you can see the ones that are negated. But what I would say is targets are more frequently negated before activation than negated after activation. And this is why you should wait for a target to be activated, because it's more likely that a target will be negated before it's activated than after it's activated. So there are two different variables there in terms of the target activation and negation. So just worth thinking about. But as I say, with the trial, I suggest that you stick to just using the target activation. So let's have a look at some of the targets here. As you can see here, this one is not in bold, and so that's been achieved. This one is still in bold, not yet achieved. Now, the key thing is this target exhausting? We're not quite getting to the target. And that's the key point, is monitoring these targets as you go. And so we can actually go through and just look at some of the targets. So these are two targets in train. Here we see another example of targets in train. And what we're looking for here is a very interesting one where we've got basically upside targets, but we've got a new downside target. And so that's the key thing, and we will have a session on resolving that when you have different targets pointing in different directions. The key thing is when you see these targets in train, that's a stronger indication that we're going towards the target. Notice how this downside target was given and exceeded. Now we're seeing these upside targets. So that's the point, is the target activation is when they're bold. And we're just looking for some orange targets so we can actually find examples of unactivated targets. And you'll find that there's not that many of them, because it's a point where we're just in that transition from a target being generated to being activated. Most targets are activated quite soon after they're given. So if we look through the charts, we can see that mostly we're seeing targets that are already activated. Here we see Bitcoin, for example, targets given and met. So the key thing is to remember that traffic light system. Green targets are upside targets, red targets are downside targets, and orange targets are unactivated ones. And when you see orange targets, it's a get ready, like that green traffic light, but you really ought to wait for the target to be activated generally. And of course, one thing you can do is, if you have a green activated target, is you can go, sorry, an orange activated unactivated target, you can go to a 60-minute chart and seeing whether you're getting a heads up from the targets on the 60-minute chart as to whether you're going to get that target activated or not. So that's lesson 3, and hopefully you find that is valuable. Look forward to seeing you for tomorrow's lesson. Hello and welcome to lesson 4. And this lesson is really one of the most important lessons of all. It is vital to consider the trend and support and resistance levels when looking at targets. And we've developed some tools that come with the targets so that you can actually make the most of understanding those points. Trend definition and targets. Price targets with the prevailing trend should always be favored. This is such an important point. And I think when people say, oh, the target didn't work, nearly always it will be because it was counter trend. And if you think about it, in uptrends, we'd expect targets to be exceeded, and in downtrends, we'd expect downside targets to be exceeded. So that's the really quite key thing. Trend state is a really important aspect of the target. So here, what I've drawn on is one of the tools that comes with it, which is the Linton average. It's a midpoint average. It's the 20, and here we recommend using 21 days. It's just a little tool to help you remember which side of the average. If I'm above the midpoint of the trading range, I'm bullish. If I'm below the midpoint of the trading range, I'm bearish. So it's just a quick reminder just to remind you what trend state you're in. So in this instance, I'm getting upside targets that are above trend, so I consider those to be more valuable. Here I'm getting a downside targets that below trend, I consider that to be more valuable. So downside targets should be favored below the average, and upside targets should be favored above the average. It's that simple. And if you get counter trend targets, just be aware that that is a move against the trend, and that's less likely to be met. So that's a really key factor. Now, you don't have to use the average that we provide with the targets. You could use your own tools for defining trend. I'm a big fan of Ichimoku. I wrote the book on Ichimoku in 2010, Cloud Charts. You can buy this on Amazon. And in this case, we're above the cloud, which is bullish, and we've got upside targets. So upside targets should be favored. What you will find is if you do get any downside targets, if you're above trend, what will often happen is you'll get a downside target and then it's negated because it didn't work out because of the trend state. So whatever trend technique you use, defining the trend is an important factor. And in fact, the midpoint average is derived from Ichimoku charts because they use midpoint averages. So that's just a one way of identifying the trend, and the average is a quick way of doing it. You might find using Ichimoku a little bit more complex. The other one is defining resistance and support. Now, we've developed this 3-bar rule, which you can amend the 3 bars, but we use the 3-bar rule where we mark on the chart the highs and lows based on the 3 bars before and the 3 bars after. So this will only draw when I'm 3 bars later and that was the low point. So it says the 3 bars before and the 3 candles after, that's a low point. I'm going to draw a line on the chart. And you can configure it to draw multiple levels of these, but this is a way of automating support and resistance and identifying turning points. And what we're looking for when we do this is that targets are lining up with levels of support or resistance. So using the targets in line with support and resistance is really quite important. And if you had to say which is likely to win, the target or the support and the resistance level, you would nearly every time say the support and the resistance level, because those are the levels at which people traded. So that's a very important thing to take into account when you're looking at the target. So you'll notice here that this target was met here. In fact, it was met a bit earlier, but that is the resistance level. That's on Bitcoin. But we can go right the way through and see where the support and resistance levels are. Now you can adjust these by going to the levels here, go to the settings. You can change the 3 bars before and after to 2 bars or 4 bars or 5 bars. You'll get fewer lines if you choose 5, and you'll get many more if you choose 2. You can decide how many levels that you wish to display, and we also display a purple level if it's a level that's just been broken. So that just tells you that a level's just been broken. So it's really quite valuable to be able to do this. And we can just go through charts and we can see the levels way back from previously that are drawn on there. And that just helps you understand the levels from the past. So if we go to the stocks, where we see a bit more variation. So if I look at, I typically just look at the Dow 30. These are large cap stocks, good examples, without making any stock recommendation. We see here, for example, that we've got key levels, and we should not be surprised if we're making new all-time highs, we're not, or new highs, we're not seeing those levels. But the key thing here is that there's a target given to that level there, and there was a previous resistance level. So you might say, well, there's down here, you get given a target to what was the previous resistance level. So that looks like a fair level. Is it the target level or the resistance level that we're going to go to? It's slightly academic. We're close on both of those. So that's really what you need to do when looking at the targets. And so we can find, for example, here's an example of Apple. You can see previous levels running through the chart. We've got targets. That's the previous high. We've got two targets, one slightly below, one to the same level and a bit higher. So we know that between those two targets and that resistance point, that is a fair projection based on the resistance and support. So you should be using the targets with levels of support and resistance. Another one that was given here, this level given way, way back. Another one that was given here to just below that level. So you can again just look and see where the target levels are from the past, and do they line up with previous levels of support and resistance. You won't always get them lining up, and you won't always get a point of previous support and resistance, especially if you're making new highs and lows. But we can see the value of being able to say, okay, I've got a target here, and I've got a support level there. I've only got my system configured to show the last two levels, but you can configure it to show all of these levels, so you can show as many levels as you want. They're still marked on the chart, but you can see there that is a reasonable projection back to the low. So just remember to use the targets in line with trend. Targets counter trend are less reliable than targets with the trend, and targets that point to support and resistance levels, you've got to take that into account as well. So trend and levels are a really big important aspect of using the targets. The targets on their own is more powerful if you use them with other techniques, especially trend and support and resistance. So hopefully that is valuable. Welcome to lesson 5, multiple targets and conflicting targets, when targets are stronger and weaker. And so this is another key aspect of using the targets. So when we see multiple targets, that gives us a higher conviction that the upside, in this case upside targets, gives us a higher conviction towards those targets, especially if those targets are pointing to the same price area. And because we can also project time, if we're seeing pointing to the same price and time area, it's what we call a cluster. And so multiple buying thrusts all pointing to the same area increases the validity of the targets and the likelihood that they will be met. So multiple upside targets, train tracks we call them, is a really key aspect. And again, here we look at a chart that's given multiple upside targets, and we take note of that. We're also remembering what we said in the last session about breaking resistance levels. So we break that resistance level, those targets start to become more valuable because we've broken a key level, and that's the target area. So multiple targets are stronger. It's a bit of a rule of thumb, but I would say 2 targets is twice as likely to be met as 1, and 3 targets, well, that's even more powerful. So the number of targets, you won't always see 3, you might just see 2, but if you see multiple targets to the upside or to the downside, that increases the likelihood. You're seeing multiple waves of buying thrusts or multiple waves of selling thrusts, telling you of the overall inherent bullishness or bearishness of an instrument. Now, sometimes so here we've got two upside targets, but we've also got a downside target. So we've got a bit of a mixed picture, and this just actually increases the uncertainty of the chart. And so when we have that, it just tells us that there's a lot of uncertainty. And this is actually US Treasury yields, and no big surprise here that the macro uncertainty is we've got upside and downside in terms of yields increasing or decreasing. The upside potential is bigger, but we've got downside as well. And you notice how these downside targets were met, and then an upside target given but not met. So in this instance, we may see yields fall before they actually rise. So resolving these targets is quite key. Here's an example of an unactivated target. So you've got these upside targets. This one is looking a little bit improbable, but we've got this one here. But now we've got this waiting to see if that activates, we would discount that target further. So resolving conflicting targets. The trend is your friend, remember. If we look at this, the general pattern here is that we are heading lower. So you would probably favor these downside targets. And we look back to how well they've been adhered to in the past. So this one was exceeded. This one wasn't quite met, but it was quite a big downside. So what we're seeing here is lower high, lower low. That target is the one that's in play at the moment, and it is the last target. So when it comes to looking at the targets on your system, you can literally go through and look for signs of conflicting or not conflicting. So here we've got two upside targets with no conflicting targets. This one was met to the downside. We've got upside targets, so that's quite strong conviction. It would be good to see a new high in the price, by the way, to feel more confident about those targets. So we can't just use them in unison. We have a previous level of price action that we are just holding, but we have got two upside targets. Here we've got two upside targets. Again, a new high would give a stronger conviction towards those targets. Here we've got a little bit more of a mixed picture. We've got a downside target, and that is the one, and the trend has been broken. We've got a downside one that's in train. If we look at Apple, here we've got upside targets, no downside targets. There was one that was met. We've got now upside targets. That gives us a stronger conviction. Two targets is more powerful than one. And as I mentioned, sometimes you don't get a target, but here we've got upside targets for Boeing, and you can see here that one was met, and we've got two new targets. So Caterpillar, we can see upside target, just breaking the trend at the moment. Has run very fast, just breaking the 21-day trend, but that is the upside target that is still in train, and we're pulling back. And so we can see here that just by going through the charts, that's how we resolve the targets. Upside target there met on Cisco, no new targets there. So as I said, you don't always get a target. Here we've got a downside target pointing back towards the level of support. So for the moment, it's hard to be bullish about this chart whilst you've got a downside target, especially if we move back below the activation level or we make a new low. So you've still got to employ the normal technical analysis techniques when you're thinking about the targets. And hopefully that is another valuable lesson in terms of understanding the difference between multiple targets in one direction and conflicting targets. So hopefully you find that valuable. Tomorrow we'll do another lesson. Welcome to lesson 6, day 6 of your trial. Now, the key thing to remember about the targets is targets are approximate. Sometimes they're met exactly, and sometimes, many times, they're not met exactly. They're either not reached or they're exceeded. And we'll talk about the importance of that in one of the coming sessions. But today we're going to talk about the fact that they're approximate. We'll talk about a little bit about trade construction. It's an area I spend a lot of time with our corporate clients. And then some of the pitfalls. And just remembering there is no silver bullet. These are a guide, an adjunct to your trading, and hopefully you'll find them valuable for that in terms of decision making. So remember, the increased accuracy of targets are about time frame, price levels, and the trend. We've talked about that in previous sessions. The time frame, the support and resistance, and the trend state are really important. So always note the key price levels. That's really important. We talked about that already. And always study the wider chart. How well have the targets worked in the past? And remember the idea of targets being achieved or not being achieved historically. So here we see an example of a downside target more than achieved. Here we're seeing a mixed picture. So it just makes it a little bit harder to say which way we're going to go. The upside targets are more recent targets, so we tend to give those a little bit more value. But this chart is roughly moving sideways, and we need to really break into these new price areas to feel more confident about those targets. The more recent targets, as I say, are the ones that we would look to as being stronger. You could say now that this target, this is on the Dow, this target at the time was less valid. These targets have come back. This one is now probably not valid anymore, and it won't be valid. Remember, it'll be negated when we move above the level at which it was generated. It'll just come off the chart, it will be negated. So for the moment, the targets, the more recent ones, are stronger. So we tend to focus on the nearest targets. When targets are no longer valid, so here we see an example where this was a target that was given, we didn't quite get there, had a big fall, and then a downside target, you'd start to say this target's now no longer valid, we're now looking at these downside targets. And those targets were actually met, and then new targets generated. So understanding, again, focusing on the nearest targets first. So here's an example of an exhausted target. That was the target that was generated. Here we got new downside targets. We had a lower high and then a lower low. Once you see that pattern, the Dow theory, you would start to just say that target is looking like it now will not be met because of the trend change. So, and we're going to talk about, in one of the coming sessions, we're going to talk about the idea of a target being not reached or exceeded and what that means. And now we've got an unactivated downside target. Again, we've got a lower high. If we go below there, there's a lower low activating the downside. So that's an exhausted target. Some of the pitfalls are beware of improbable targets. And so that's a really key point here, is sometimes you will have targets that just are improbable, and you should always focus on the nearest targets first. They will be met before the improbable ones. And long-term charts, you will often get improbable targets. So here we have a target on a 5% chart of gold to 13,500. That is not code to go out and say, he said gold will go to 13,500. It's just that it's a very improbable target, and it points to 2063, the year 2063. So if gold does reach that level, I hazard a guess will happen before 2063. But don't get too excited about improbable targets, and beware your big moves. So here, this is Bitcoin again projecting very big upside targets. It's a big box size. That's exaggerating the frame of the chart. So the other key point, just as a pitfall to remember, that on TradingView, you might be looking at data, the same data from different providers. So on currencies, for example, there are multiple providers on TradingView, and it may well be that the data is different. So here we're looking at gold. This chart is coming from one provider, and here we're seeing it from another provider, and we can see we've got two targets here and only one target there. So it may well be that you will get different results on the same instrument provided by different providers. So you just do need to be aware of that. Now, the key thing about this, I just talk about trade construction, is the targets are an aid to trade construction. This is quite a complex area, and I cover this a lot with corporate clients when we do training. But here we're saying, here's the target, and you could start, if we activate this target, you could start to do a trade. So you could say, well, the downside is $7, and my stop here would be roughly $3. So that's more than 2 to 1 risk-reward ratio. and I can just use that for constructing a trade. So you may not even use the targets for the price actually getting to the target. It's just helping you understand where's the stop level, where's the target level, is this a trade worth taking? And once I'm in the trade, I'm going to be monitoring it anyway. So the targets are helpful in terms of trying to construct the trade, and that's a very important point. And I think, you know, if we look through some charts, and if you want to take a trade, so let's take an example, and this is by no means a recommendation. Here you've got 8% upside and 12% upside, and there's the midpoint of that, say 10% upside, and then you could calculate the downside and say what's the risk reward? Where do I get out? What's my stop? And what's the potential? And is that enough to justify a trade? So targets don't necessarily, you don't just hang your hat on the target. It's just a way of entering the trade and saying, actually, I can see the price targets and I can see where I would stop. Is this a favorable risk reward ratio? So they're very valuable in terms of trade construction. And it's something we spend a lot of time training our corporate clients on. So really quite key as well. So just remember, there's no silver bullet. There are some pitfalls in using the targets, but all in all, they're an aid to help you making trading decisions. Lesson 7. I'm often asked, should you use log scale or arithmetic when it comes to using the targets? And it depends on how and what you trade, really. If you're not sure, I recommend you use the defaults in TradingView, which are log scale, because the advantage of log scale is it will just deal with whatever price unit, whatever price an instrument is. But thinking about log scale, true log scale, the real value of it is if I just use log scale on any instrument, no matter what the price is, it will just calculate the units and therefore the targets. Now, the key thing about log scale is that the unit size varies as the price goes up. And so for something that's changed very dramatically, if you look at a chart, say, of NVIDIA, where you have big moves, or Bitcoin, or anything that's had very dramatic change, it makes more sense to look at a log scale chart than it does an arithmetic chart, because that looking at the chart in percentage terms rather than just straight arithmetic. Now, the same thing with log scale is if you're using the targets, it will exaggerate the upside targets. If something's been rising, bigger upside targets, because it's too log, and it will actually underestimate downside targets because the units are getting smaller as you go down. So it's just worth remembering that on log scale, your upside targets will be exaggerated and your downside targets will be less exaggerated. And so that's just something to consider. But the real value of using true log scale is you can just apply it to any instrument, and which is why it's set up on the default on your system, because it just means whatever targets you look at, it's just using on daily this 0.5% log scale, and on 60-minute this 0.05% log scale. And so those are the settings, and it just means out of the box, you're straight away seeing the targets as you want. So when should you use arithmetic, if you like? And that's where the unit size is linear. And here we see the unit size gets bigger and bigger. That's log. When you should use arithmetic is when you trade an instrument intimately. So if you trade crude oil, for example, and that's all you trade, then using arithmetic, especially intraday, probably makes more sense. These unit levels will be the psychological levels at which people trade. So that's, a 10 cent, whereas a log scale, it will just be a percentage of the price, and it will not be necessarily the levels at which you trade. So if you're trading something intimately, whether it's Bitcoin or a currency or crude oil, and you're focused on that one thing, then using log scale makes sense. Because those unit levels will line up with the levels at which people are actually trading. So that's a good time to use arithmetic. Now, if you're a stock picker you're running through lots of different charts of lots of different instruments, log scale makes a lot of sense because the defaults choose the unit size for you, and you'll get meaningful targets on all your charts straight away. So really, you'll notice that nearly always I'm using log scale because it just means that whenever I look at a chart, it's finding the thrusts, it's finding in this instance, the buying and selling thrusts and putting the targets on the chart for me. So here I'm just using a straight 0.5% on any chart. Now you can change the unit size if you want to. Go to the settings, and if you go to the target settings here, you can step away from using the defaults. You can put in your own manual levels if you wish, but I do recommend, as you're getting used to the targets, just use the defaults. 0.5%, we've done a lot of research on this, 0.5% is the level that seems to work best on daily charts. And if we go to 60-minute charts, you will see here the levels now changing as well. Upside targets there and downside targets. And the unit size now down here is 0.05%, so a tenth of what we're using on the daily chart. So it's effectively dealt with for you in the defaults. And so my recommendation is just use log. And you'll notice on log that the target levels, if we go back and look at some of these levels, when we get the targets drawn on, you'll notice that these targets are not at round numbers. Now, if you're using arithmetic, you will have round numbers. But this is because of the log scale, it is producing numbers that are not arithmetic. But remembering that the target is just an aide memoir. Don't hang your hat on $310.46. It's just generating a target to that price area. So that is a factor. When you're using log scale charts, the target levels will be different. This is a 60. If we go to a daily chart of Apple, there I'm in the 60-minute chart. You can see 262.72 and 252.44. Those are off those buying thrusts generated log scale. Don't get hung up on those numbers. It's just pointing to potential around those areas. So that is one of the factors in using log scale. The targets will not be exact numbers. So hopefully that just explains the difference between using arithmetic and log. I recommend you stick to log. Day 8, just a couple more days to run on your trial. And here today we're going to talk about achievement and non-achievement of targets. And this gives us clues to the bullishness and bearishness of an instrument. And it's an area that's really often misunderstood. And there's a very big part of point and figure targets back in the day. So the easy way to remember this is bullish confirmation on an upside target is if the target is achieved or exceeded. And on a downside target, it's bullish confirmation if the downside is not reached. So there are two conditions of bullish confirmation, one to the upside and one to the downside. And what this really is that this initial wave of buying and then the activation that produces the activation of that, this initial wave of buying produces an overall potential for the price to go to. And really, this is the conviction, if you like, and this is the continued conviction. If we reach the target, these people didn't sell and they held their position and more people got in. And in the downside case, if we don't reach this downside, the sentiment changed, we saw downside potential, and we weren't reached. Now, I should also mention trend state. In an uptrend, you will find upside targets are being met and exceeded, and downside targets are not being reached. That's just because they're counter trend. And just remember what we said about log scale in the last session. Log scale downside targets are under exaggerated, and log scale upside targets are over exaggerated because of the log scale. So don't be surprised to see downside targets not being reached. And the key point here again is just think about the sentiment. This was what was meant to happen. If it happens, that's bullish confirmation. If it doesn't happen, if we don't reach that level, that's bearish confirmation. Here, in this instance, if we do hit the downside, it was more bearish than, if we go past the downside, it was even more bearish. But if we don't reach that level, new bullish sentiment has kicked in. And of course, the reverse is true for bearish confirmation. An upside target not being reached is bearish, and a downside target reached or exceeded is bearish confirmation. So the key thing is continued conviction failed here. For whatever reason, the sentiment changed. We didn't get to the potential here. For whatever reason, actually, the bearishness just increased. And that is, so when we look at the targets, are they being met or are they being exceeded? And we look back at the previous targets to see that. So here we see a target that was not reached. We then saw a downside target, a lower high, and then a lower low. We know that that target was not reached, and we're starting to see lower high, lower low, and a downside target. That's bearish and bearish confirmation that we didn't get to the target. So there's just a whole load of bearishness wrapped into that. And then here we just can now say that target is no longer valid, it was not reached, and there was just bearish confirmation. That's a target that's exhausted. Remembering the status of upside targets. So it's very hard to call when there's exhaustion on a target. One of the techniques we use, which is follow the price, does help you deal with that because it tracks the target. But really, these are the different target statuses that we talked into one of the previous lessons. And the same thing with status of downside targets is, are we reaching a point where we're not reaching the target? So the key thing is how well have the targets worked previously. Downside target that was exceeded, downside target not quite met, upside target not quite met. The trend state, remember, there's lots of things to consider than just the targets on their own. So trust the targets less if they haven't worked very well in the past. And so if we go to examples, we can see here downside targets met and exceeded. That was bearish, but it confirmed the targets worked, gives me more confidence in those targets. And we can just go through looking at different charts. Here, downside targets given and met, an upside target met. This is a big target, but I do have targets that worked. So I do have to just place a little bit of credence in those targets. Here, downside targets met, another downside target. It's hard to ignore the fact that the previous ones were met. Here, targets all exceeded. So to the upside exceeded, to the downside exceeded, to the upside exceeded. So if I do get targets, I just can be aware of the factor that these targets may be met and exceeded. So here's an example. Target met, resistance level, same target to that resistance level. Do I value that target more so? Downside target not reached, that's a kind of bullish confirmation. The fact that we didn't reach that target's no longer valid. It will be negated if we make a new high. So you've just got to think about looking back and seeing how well the targets worked. So that's another factor in using the targets, and I hope you find that valuable. So it's day 9. You've been hopefully getting value from the targets these last several days. And it's the end of your trial tomorrow, but I really wanted to explore this big area, which is time to target. And one of the biggest values of being able to put the price targets on time-based charts is we can effectively make an estimate on time. But the one thing I would say is don't get too obsessed with time to target. And it's very easy to say, oh, well, we're not following that trajectory. That in itself is information. Are we finding are we running to target or not? So the idea behind the point and figure targets was that you had an upside potential, but we didn't really ever talk about time to target because point and figure charts had no time scales. So the first rule of the targets originally was there is no time scale. But we've tried to address that by looking at different methods for how long it will take. Now, there are 5 different methods in the system with your targets, and I'm going to run through them very quickly, but I have to tell you, I predominantly use method 1, which is the default that your system is set up to. It's the simplest and it's the preferred method, but let's have a quick look. So time ratio is really quite simple. It draws the targets on. Your default is 2 to 1. So basically, so here we are just literally seeing 1% every 2 days, because there's a 0.5% is the unit size. So that's 1% every 2 days. So 2 to 1 is what we use, and we can see straight away on this chart of IBM, the target was given here, back there, but it was still not reached. This one's still not reached, and this one's still not reached. So we know straight away that the target trajectory is wrong, and we could actually go and change the trajectory. And if we go and change it to 3 to 1, we start to see now that we're somewhere in that cone, if you like, in the train tracks. So 3 to 1 is likely to be more accurate for this stock than 2 to 1. But stick with the default of 2 to 1. You can change I'll show you how to change it in a minute, but it just tells you that actually that's more the level that we're running to. And you can see here we've got up 3, down 2. That is literally the ratio that's being used, and that's what shows on your chart. The second method is thrust angle, and this one basically says the initial move, the steepness of that initial move will govern how quickly we move to target. And you'll notice now that the targets are not running parallel, because this move took longer, therefore this target will take longer. This move was quite quick, therefore that target is quite quick. So it's just another way. There's no account of time to activate, and the targets are not parallel. If we go the other way, time to activation, here we take account of how long it took to activate. So this target took a long time to activate, so it's taking a long time for the target to be met. So it's just another method, and different people will find using these methods might produce better results for them. But as I said, I recommend you stick with method 1 to begin with, rather than dancing around all the different methods. This one's quite a good one. This is follow the price, and basically this basically says don't know how long it's going to take. I'm just going to project the targets based on where the price is going. Now here we've got 3 targets, and they're all pointing to different places, but they're intersecting here because we're ignoring the last n bars. I normally typically say 5 or 10 bars. I want to ignore 10 bars here. Why would I want to ignore the last 10 bars? Because I want to see a move away from the trajectory. So this is quite a good method. It just says we don't know when the target will be met, but what we're going to do is we're going to track the movement and keep progressing the target based on how we're tracking. So this can be a pretty good one, actually. And then the last one is the historical average. So it's based on how many targets you've chosen to show, and it uses the number of targets configured up and down. And here in these units in the bottom, it produces the average that it takes to reach the downside or the upside. So that again is quite a good method. And so here we see the last 20 targets. How long did it take? Here we've got the units, upside targets. Those targets are based on the historic of 20 units. So the last 20 targets, that's what's happened. So that's again quite an interesting one. This is NVIDIA, average of the last 20 targets. That's what the target time projection is based on that. So how far can you go back? You can show up to 50 targets. There are limitations with TradingView and the scripting language. It has processing limitation limits. In Updata, we have these targets. You can go back as far as you like. I mean, a long way back and back test them, but we can't do that in TradingView. So here we're seeing, again, an upside target on Bitcoin, $223, based on the historic average of the last 50 targets. So that's quite key, and I think we've got quite close to that. We can take a look in a minute. In fact, let's just look at Bitcoin now. So if I go and look, $123, that presentation was given a while back. Looking at Bitcoin, where do we get to? $124. So, and don't forget that was given when we were sitting at 109. So, it's not rocket science. And you can see here the upside target was to that level as well. So really quite key. This is using the 2-to-1 method. So it gave roughly the same target. And that chart there is using the historical average. It's just so happened that the two different methods produce roughly the same target. So in terms of changing these, and I'm going to go back to stocks because we can see if we go back to the stock list, what the effect is of changing from charts. So I'm going to try and find, oh, there we go. So here we've got 3M. Those targets are still in train. We're actually running, if you like, trajectory below the targets, and you might feel that you want to go and change that trajectory, time up, time down. If I change that to 3, watch what happens to the targets. You can see now that that trajectory is probably more likely because that's running the trajectory of the targets. And I could go through and stick with 3 if I want, and I'll have now different time projections based on that. You can change the up and the down. Here, Apple, we were running 2-to-1. It's now a 3-to-1, pointing to December at those levels. Whereas if I go back and change that to 2-to-1, I'm going to just hover on that little settings dialog, go back and change that to 2. Okay, you can see then we're in the middle of those targets. So that's how you change them. I quite like keeping it at 2-to-1 because I can then just see, am I running ahead of target in my default or am I running behind target? I could change them. I can change the trajectory to see, which way. But ultimately, I do find it's valuable to play with those levels if you want. But are we running to target? That's the key question. So that's how you change the time to target. I recommend you stick with that first level, which is the price time projection, just the ratio of the two. Play with that for a while before you start playing with lots of different settings. So it's the last day of your 10-day trial, day 10. And hopefully you've got value for the last 10 days. And today I want to just talk to you a little bit about the settings and going a little bit further with the targets and how you keep up with my work on the targets and following me really on a daily basis. So the key point about the targets is the settings for the levels. I love these, just these resistance levels drawn on automatically. The settings for these is really very, very straightforward. You can change it to 3 bars before, 4 bars or 5 bars before, or 2 bars before. It just basically says how many bars before and how many bars after do I then set a level. You show the last number of levels, and you can also put dotted levels, ignore periods that are over a long time ago, and you can show how many you want to show, so and how wide they are, how they extend. So there's lots of configuration. I think really 3 levels either way is about ideal. I've said 2 is quite good, but actually I think 3 is pretty good. Average settings is very straightforward. It's just a period. It's all you have to do. I like 21 days. It's a Fibonacci number, and just think that's a really good level to use. So just using those levels just to keep you in mind, am I getting targets above the trend? Am I getting targets here below the trend? Just another tool on the chart to help you. and so that average is in place there just to make life easier. You'll find that this is the midpoint of the trading range. You'll find that normal moving averages are just a bit too smoothed and a bit slow. You can use close prices versus high prices. You can change those. I use close, but you can use high, low, and I'll give you slightly different targets. So here you can see the target wasn't activated. Here it is because the high went through the activation level. So that is a factor, but I tend to use just closing prices. You can change the factor of how how far you want the target. So one times the thrust. So here is 1 times. This is the classic pattern, if you like. Move into the pattern, sideways, move out. Fibonacci, you could use 1.618. If you're a Fibonacci fan, you could use 2 arithmetic, which is the classic point and figure, or 2 log. Your default is 2 log. That's what I use. Remembering upside targets will be exaggerated and downside targets will be under exaggerated. You can adjust the pullback. I really don't recommend you do this, but it's there. It's a possibility. The bigger the pullback, the bigger the effect on the target. So this is a normal 3 reversal. That's the default on your system and what I recommend you stick to, but you can change the reversal to 2 or to 4 if you wish. You will find 2 produces more targets and 5 produces too few and exaggerated. So stick to 3 is my advice. This just shows what all the different settings relate to, and you can get these slides. It's in the original big presentation, but just highlights. There's quite a lot of settings if you want to change, and colors as well. The defaults are all set up, and I recommend you stick with the defaults until you're confident to start playing around a bit more. And just thinking about the visualization, again, these slides are available in that big slide deck that hopefully you've referred to. We do update the system. We get a lot of feedback, and if you see this updates available, you can just click on that and you'll get the latest targets update. So that's quite valuable as well. They're appearing on more and more platforms. They're on Bloomberg, they're on Updater, there on TradingView. There's more platforms coming. Updater runs on lots of different data sources, so effectively you can run on those different platforms that way. But if you're using TradingView, it's a really brilliant system, I have to say, and I use it quite a lot myself. You can scan for the targets in Updater, so want to find charts that have got targets that are greater than 2, or that are longer in the future. You can do scanning, and that's really quite powerful. And you can backtest them in Updater as well. We've done quite a lot of backtesting. And what we have found is with money management stops, the targets work better. So use the target to enter the trade, and then it's about money management from there on. And that's a key message, really. So key points about the targets. They are approximate. Not all targets are achieved. Turning points to key price levels increases the likelihood. So think about resistance and support. Model targets pointing in the same direction or price area, that's clustering. And the nearest targets must be achieved first, and be aware of improbable ones. Targets not reached or exceeded, remember that indicates bullish and bearishness. You can have opposing targets, and you favor the ones with the trend. And do understand this idea of negation and activation. That's really quite important as well. So how to keep your skills up? Well, rewatch these videos. Rewatch the big main video that goes from start to finish. It's over an hour long, goes right the way through the targets. Most people struggle with the targets because they don't really understand. They haven't really put the work in to understand how these targets work. If you're point and figure chartist, you'll have no worries in understanding how these targets work, because you will have been using them on point and figure charts, and you will have gained a lot of knowledge on how to use the price targets. So do rewatch that video. Read the peer-reviewed paper on the IFTA website. If you just Google IFTA, you will find that site, and there's a heading there on the website under journal. It's the first article in the journal, and it is effectively reviewed by lots of technical analysts, and so you'll find it there. Follow me on LinkedIn. I've got over 33,000 followers. I can't have any more than 30,000 connections, so you can follow me there. Watch chartstoday.com, and I'll be doing more and more daily commentary with the targets there. I do these monthly surgeries with the London Stock Exchange. If you've got a corporate email, you can register for those. And I will be sharing each of those sessions soon. So again, if you're a client, you'll get access to those. See me at conferences. I'm speaking at the CMT conference in Dubai, the IFTA conference in Frankfurt this year. I speak at a lot of events. And if you want, buy my book on Amazon, Cloud Charts, Learn Ichimoku, a really great technique. So take the price targets challenge. You've had 10 days. Hopefully you've had maximum use of those 10 days. Do the targets make more than $100 in the next 30 days? That's the really big thing. And if you're finding that they're helping you, take a trial. You've had the free trial. Sign up for a month and see what difference it can make over a month. Remember the resources. You can go to updated.co.uk TV for TradingView, and feel free to email me at any time, tia@updated.co.uk, and the help desk will help you as well. So hopefully you'll take this challenge, and hopefully you found these 10 lessons useful. And welcome aboard. Bye for now.